Our top story is what one of our committee members is doing today, and that is Stephanie Link, because she is buying more Caterpillar as it is one of the bigger decliners today. Why are you making that move?
Because I looked at the quarter and I studied it, and it was much better than the headline. If you go through and you look through the currency impact on a one-time basis, adjusted earnings beat by 21 cents and grew 43% year over year. Core operating income grew 78% year over year. Margins beat by 130 basis points. So to me, and then I go through all of the various different segments, and every single segment beat on the sales line, and they got double-digit pricing and in 2 out of the 3 divisions that they have. And so I thought those numbers were pretty good.
So
I think people are nervous about the restocking. You're going to ask me why the stock is down. It's the headline number.
I wasn't. I was going to ask you, how do you weigh the fact that North America demand remains strong? That's what the company said.
Right.
That's really important, obviously, right? But that China remains weak. So offset both of those and how you're thinking about why you added to the stock.
Right. Well, I think China is in the process of reopening, and I think that's going to be your tailwind second half of this year into next year. So I think U.S. will stay strong. I think their digital effort will stay strong in all of the various different divisions around the world. And so you have margin upside from that, from pricing power. That's going to offset inflation. Inflation is coming down. We're going to talk to Steve in a minute about that. So to me, I think you have what I talk about all the time, Scott, operating leverage, positive operating leverage, I think, at least this year and into next year. Now, the stock is up 62% from the September lows, so it has had a nice run.
I'll say.
So I get why it's down, and I get why it's also down. There's some restocking issues. I think that's a big question mark for the bears, not for me. But I just think that there's so many more positives than negatives, and I just think there's an extreme reaction. You know, I call earnings season silly season for this very reason.
Yeah. Well, I mean, what they report and what meets the eye is maybe not how the whole thing plays out. Now, so Leisman's here, and you mentioned him. You know, we use companies like this to sort of get a gauge on what's happening in the global economy. The data today suggests weakness. Steph says inflation's coming down. We know wage gains are slowing, right? We had the employment cost index verify that yet again today. And here we are on day one of the Fed meeting with you with a Fed survey that has some, I think, really interesting results as it relates to inflation and the economy and what people expect.
Yeah, I mean, there are a lot of cross currents. Sure, what was GM today? They were kind of positive, right?
Kinda. Stocks up like 8% because they were really positive.
So we're going to sell cars, we're going to sell tractors, and we're going to sell planes. We know that from Boeing. I don't know. It's hard to be too pessimistic. And by the way, Scott, the recession probability did come down. It's really elevated, but it was like at 60%. Now it's down to 50%. Normal is about 20-25%. So both in Europe and the U.S. it came down. But just take a look, guys, quickly at the Fed expectations. And I think the one screen kind of tells it all, if you will. 25 expected at this meeting tomorrow. 82% see another 25 coming in March. You reach a peak rate of 5%. You stay there for 9 months on average. Some guys are at 4 and some guys are at 18.
That's a little more hawkish than what the market says.
It is a touch more hawkish. And then it's a little more hawkish, but it shows the division. Both the respondents aren't united and they're not synced up with the Fed as well. 44% looking for rate cuts, both by December.
And 44% say a hold. Right. So you really have a split.
Exactly. Let me give you one factoid, which I kind of like.
Yeah.
Guys, put up the S&P chart that I have there. I just, because I like to do average if and count if and have fun with Excel. So you don't see it there, but that's the outlook. Flat for this year, essentially, is the average outlook, and then up 10% for next year. So what I did is I said, what if you have a Fed outlook that's under 5%, what's your S&P forecast for this year, and what is it if you're over? 200 basis points separate, 200 points separate those who have the Fed doing more versus those who have the Fed doing less.